Welcome to General Finance Corporation's earnings conference call for its second fiscal quarter ended December 31st, 2020. Hosting the call today are Mr. Jody Miller, President and Chief Executive Officer, and Mr. Charles Barrantes, Executive Vice President and Chief Financial Officer. Today's call is being recorded and will be available for replay beginning at 2:30 p.m. Eastern Time. At this time, all participants have been placed in a listen-only mode, and the floor will be open for your questions following the presentation. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If your question has been answered and you wish to remove yourself from the queue, press the pound key. We ask that while posing your question that you please pick up your handset to allow optimal sound quality. It is now my pleasure to turn the call over to Mr. Chris Wilson, Vice President, General Counsel, and Secretary of General Finance Corporation. Please go ahead, Mr. Wilson.
Thank you, Operator. Before we begin today, I would like to remind you that this conference call may contain certain forward-looking statements. Such forward-looking statements include, but are not limited to, our views with respect to future financial and operating results, competitive pressures, increases in interest rates for our variable interest rate indebtedness, our ability to raise capital or borrow additional funds, the availability of sufficiently qualified employees to staff our businesses, changes in the Australian, New Zealand, or Canadian dollar relative to the U.S. dollar, regulatory changes, customer defaults or insolvencies, litigation, acquisition of businesses that do not perform as we expect or that are difficult for us to integrate or control, our ability to secure adequate levels of products to meet customer demand, our ability to procure adequate supplies for our manufacturing operations, labor disruptions, adverse resolution of any contract or other disputes with customers, declines in demand for our products and services from key industries such as the Australian construction and transportation industries or the U.S. construction and oil and gas industries, the disruption of operations from catastrophic or extraordinary events, including viral pandemics such as the COVID-19 coronavirus, or a write-off of all or a part of our goodwill and intangible assets. These risks and uncertainties could cause actual outcomes or results to differ materially from those described in our forward-looking statements. We believe that the expectations represented by our forward-looking statements are reasonable, but there can be no assurance that such expectations will prove to be correct. For more details regarding these risks, please see the Risk Factors section of our periodic reports filed with the SEC and posted to our website at www.generalfinance.com. These forward-looking statements represent the judgment of the company at this time, and General Finance Corporation disclaims any intent or obligation to update forward-looking statements. In this conference call, we will also discuss certain non-U.S. GAAP financial measures such as adjusted EBITDA. A reconciliation of how we define and arrive at adjusted EBITDA is in our earnings release and will be included in our quarterly report on Form 10-Q. And now I turn the call over to Jody Miller, President and Chief Executive Officer. Jody, please go ahead.
Thank you, Chris. Good morning, and we appreciate you joining us today for our second quarter 2021 conference call. I will begin with a brief discussion of our operations, then our CFO, Chuck Barrantes, will provide a financial overview and our outlook for the remainder of the fiscal year. Following his remarks, we'll open the call up for questions. We are very pleased with our financial performance in the second quarter, despite the ongoing challenges created by the pandemic. Once again, the results well exceeded our expectations. Our North American leasing operations at Pac-Van led the way with a 9% increase in rental revenues from our core non-liquid containment products. Containerized products led the way with a 10.9% growth, and total revenues were up 5% year over year. Overall leasing revenues were up 3% at Pac-Van, including tanks, with year-over-year growth in some sectors and modest declines in others. Our ground-level offices continued to see the highest demand across our core product offering, experiencing year-over-year increases in both pricing and volume. Sales in North America were up 11% year-over-year. Just like last quarter, some segments have shown decline in this uncertain economic environment, but this was more than offset by a number of COVID-related sales. Going forward, we will continue to monitor trends that impact our business, such as non-residential construction starts and special events. We believe as the economy reopens, projects that have been delayed will restart and more public entertainment events will resume. Our liquid containment business, primarily Lone Star, experienced reduced customer activity from lower levels of oil production in Texas during the quarter when compared to second quarter last year. However, we did experience modest rebounds in both pricing and utilization compared to last quarter. We are still operating under significantly lower levels than fiscal year 2020, but we are cautiously optimistic we'll see sequentially improved results in the second quarter of the fiscal year as we have seen better trends as of late. As I mentioned before, we have implemented measures to control costs without sacrificing our service levels or safety and are effectively managing through the ongoing challenges in this sector and expect to be well positioned to serve our primarily blue chip customers when the market normalizes. Our North American manufacturing operations posted lower year-over-year revenue in the quarter as expected due to reduced sales of liquid containment tanks and specialty tanks, offset somewhat by ongoing demand for GLO modifications, primarily from Pac-Man's leasing operations. Despite the lower revenues, adjusted EBITDA was a small loss for the quarter and was slightly improved from prior year quarter. Now turning to the Asia Pacific region. Adjusted EBITDA was up 5% in the Asia Pacific region, while revenues were down 2%. The Australian dollar continues to strengthen against the U.S. dollar between periods, providing a lift in reported revenues and adjusted EBITDA. In local currency, revenues were down 9%. However, last year we booked 2 large sales in the transportation sector, which were not repeated this year. Excluding the impact from those 2 transactions, revenues would have been up 7% year over year. Leasing revenues were down approximately 3% in local currency, mainly due to a revenue decrease in the construction sector as modest improvements in some sectors were offset by slight declines in others. Our Royal Wolf team remains focused on helping its customers get through any disruption and returning to business as normal. Both the Australian and New Zealand economies continue to recover as new COVID cases in both countries are very low and expected to remain that way in the near term. In general, economies across the region are experiencing renewed growth, which should also benefit the Australian and New Zealand economies going forward. To conclude, our resilient business model, anchored by a containerized fleet with long economic lives and very low maintenance requirements, provide us with the ability to generate free cash flow and reduce debt, which we have done in the first half of fiscal 2021. We continue to manage our discretionary CapEx and acquisition investments prudently, and we are the strongest financial and liquidity position we've ever been at in the company. While our fiscal year 2021 will likely remain challenging, we will continue to monitor the situation across all our business units and are confident in our ability to navigate through this environment. I'll now turn the call over to Chuck Brianes for his financial review and our outlook for the remainder of the fiscal year. Chuck?
Thank you, Jody. We will be filing our quarterly report on Form 10-Q shortly, at which time this document will be available on both the SEC's EDGAR filing system and on our website. And I encourage investors and interested parties to read it, as it contains a substantial amount of information about our company, some of which we will discuss today. Turning to our second quarter financial results, total revenues were $89.1 million for the second quarter of fiscal year 2021, compared to $92.1 million for the second quarter of the prior year. Leasing revenues were $58.4 million, down from $60.8 million, and comprised 66% of total non-manufacturing revenues for the quarter, down 67% from the prior year. Leasing revenues, excluding the oil and gas sector, increased by approximately 5% in North America and by 4% in the Asia Pacific area. Non-manufacturing sales revenues were $30.2 million in the quarter, up from $29.7 million in the prior year. In our North American leasing operation, total revenues for the second quarter totaled $59.4 million, a decrease of 2% from the second quarter of fiscal year 2020. Leasing revenues decreased by 7%, primarily in the oil and gas sector, and substantially all attributable to Lone Star. This decrease was partially offset by increases in the commercial, construction, government, and mining sectors. Sales revenues increased by 11% between the periods. In our Asia Pacific leasing operations, total revenues for the second quarter totaled $29.2 million, a decrease of 2% from the prior year. The Australian dollar strengthened against the U.S. dollar between the periods, so on a local currency basis, total revenues decreased by approximately 9%. The decrease in revenues in local dollars was driven primarily by lower revenue in the transportation sector and was partially offset by increases in the mining, moving and storage, consumer and retail sectors. As Jody mentioned, there were 2 large sales in the transportation sector last year, which weren't repeated this year. Leasing revenues were down approximately 3% in local currency due to a modest decline in average monthly units on lease, somewhat offset by higher average lease rates. Revenues at our North America manufacturing operations for the second quarter were $1.9 million and included intercompany sales of $1.4 million from products sold to our North American leasing operations. This compares to $3.1 million of total sales, including intercompany sales of $1.5 million during the second quarter of the prior year. Our manufacturing operations experienced lower demand from external customers for liquid containment, specialty tanks, and other miscellaneous parts. Consolidated adjusted EBITDA was $26.8 million in the second quarter of 2021, up 2% from the prior year's quarter, and adjusted EBITDA margin as a percentage of total revenues was 30% in the quarter, up from 29% in the second quarter of 2020. Adjusted EBITDA exceeded our expectations for the quarter, mainly driven by significantly better than expected results at PacVan, but also due to moderately better than expected results at Royal Wolf and Lone Star. In North America, adjusted EBITDA for our leasing operations was approximately $19.6 million in the second quarter, compared to $19.9 million for the year-ago quarter, a decrease of approximately 2%. Adjusted EBITDA at PacVan increased by 8% to $19 million, and adjusted EBITDA at Lone Star decreased to $664,000 from $2.3 million in the year-ago quarter. However, Lone Star did generate a sequential increase in adjusted EBITDA from the first quarter's $284,000 level. For our manufacturing operations on a standalone basis, adjusted EBITDA was a slight loss of $41,000 for the quarter, compared to last year's second quarter adjusted EBITDA loss of $97,000. Asia Pacific's adjusted EBITDA for the quarter was $8.3 million compared to $7.9 million in the year-ago quarter, an increase of 5%. On a local currency basis, adjusted EBITDA decreased by approximately 2%. Interest expense for the second quarter of 2021 was $6.7 million, down from $6.9 million last year. This decrease was comprised of an increase of $200,000 roughly in North America and a $0.4 million decrease in the Asia Pacific. In North America, the weighted average interest rate was 5.9% during the second quarter versus 5.8% in the year-ago period, primarily due to an additional $0.6 million of interest from having both public issuances of senior notes outstanding for a period of time before the redemption of our 8 1/8 notes. In addition, the current year period included a $0.4 million write-off of unamortized financing costs related to the 8.125% notes. However, average borrowings were lower between the periods. In the Asia Pacific area, the lower interest expense was due to both lower average borrowings and a lower weighted average interest rate of 7.3% versus 7.7% in the prior year period. This was partially offset by a stronger Australian dollar between the periods. Net income attributable to common shareholders in the second quarter was $8.3 million, or 27 cents per diluted share, compared to $9.5 million, or 30 cents per diluted share in the year-ago quarter. Including these results were non-cash benefits of $2.6 million and $3.9 million in fiscal years 2021 and 2020, respectively, for the change in valuation of the standalone bifurcated derivatives. Both periods also include $922,000 for the dividends paid on our preferred stock. During the first 6 months of fiscal year 2021, the company generated cash from operating activities of $29.8 million as compared to $37.5 million for the year-ago period. Turning to our balance sheet, at December 31st, the company had a net leverage ratio of 3.8 times for the trailing 12 months, consistent with September 30th and comparable with a 3.7 times net leverage at June 30th. Our better-than-expected results generated free cash flow and debt reduction during the first 6 months of the fiscal year, and we expect to continue generating strong free cash flow for the remainder of the fiscal year. In addition, we successfully completed a $69 million public offering of 7 7/8% senior unsecured notes that mature on October 31, 2025. The net proceeds from the offering, combined with amounts drawn on our North American credit facility, were used to redeem the entire amount of our $77.4 million 8 1/8% unsecured senior notes that were to mature on July 31, 2021. As a result of these transactions, combined with our solid second quarter financial results, we have strengthened our financial position and reduced our overall cost of capital. Turning to our company-wide outlook for the remainder of fiscal year 2021, given the ongoing nature of the pandemic, it remains difficult to reasonably predict the extent to which our results of operations will ultimately be impacted in fiscal year 2021. However, based on our first half results and depending on conditions in the oil and gas sector in Texas and the translation effect of the U.S. dollar, we estimate that consolidated revenues for fiscal year 2021 will be in the range of $335 million to $350 million, and consolidated adjusted EBITDA will be 5 to 10% lower in fiscal year 2021 than from fiscal year 2020. This improved outlook does not take into account the impact of any acquisitions that may occur during the remainder of fiscal year 2021. This concludes our prepared comments, and I would like to turn the call back to the operator for the question and answer session.
Thank you. At this time, I would like to remind everyone, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. If your question has been answered and you wish to remove yourself from the queue, press the pound key. Our first question comes from the line of Scott Schneeberger of Oppenheimer.
Thanks very much. Good morning. I guess my first question will be just around the quarter. Really nice performance. Could you guys discuss a little bit relative to your internal expectations, what drove the outperformance in the quarter? Specifically, maybe if you could rank the top 2 or 3 items that you saw versus your internal expectations, and then obviously with a thought to guidance going forward, that increase if it's the same drivers that are driving that. Thanks.
Yeah, thanks, Scott. I'll take the first part of the question and let Chuck jump in. But yeah, as we mentioned on the call, I think Pac-Man well exceeded our expectations. We had a good quarter, really across the board. If you look at all the different segments, I think the team has done a good job on execution, on maybe gaining a little market share. No doubt there's some COVID-related business within that's offset maybe some of the construction sector and other areas. But I think just, our product being out on the street and people seeing it, and then, again, execution, I think, has been very, very good. Retail was strong, kind of similar in revenue numbers as last year. We had a few more units on rent this year, but the big retailers did a little better job managing their rental fleets, so revenues were pretty close to last year's numbers, but that's how I'd characterize Pac-Man. Australia had a great, quarter, all things considered. They had a couple large sales that got pushed a bit, and as I mentioned on the call, we had a couple really large sales in the transportation sector last year. If you take that out of account, they were up about 7%. So, across the board in our core products, really what drove it. Lone Star is starting to see, increased activity, and as I mentioned, we're cautiously optimistic that will continue. But Lone Star and Southern Fab were a small part of it. It was mainly due to the core push.
And then, Scott, let me add this with respect to the outlook, from springboarding from our second quarter and 6 months results. We forecast that into Q3 and Q4, but we're also forecasting some nice sales increase in the Asia Pacific in the next 2 quarters and a favorable translation effect.
Great, thanks. That's good color, guys. I 2 follow-ups. One on Lone Star. Just curious. You guys sound cautiously optimistic, and I understand visibility is not great. But could you share maybe a level deeper on some customer interactions? I think I heard that rates were up sequentially, first quarter to second quarter. So, that's great to see and interesting to see. I would think that would lag, though. That wouldn't lead. So just curious, what is occurring and what is developing as we're a month into this quarter? Thanks.
Yep. Yeah, Scott. I mean, I think from our perspective, we're coming out of the trough. There's no question. We were in the trough, and if you look at the rig activity, again, we don't do a tremendous amount with the rigs themselves. We're more around the production completion, which is the fracking and completion wells. And what we're hearing from our customer is increases. And would already probably be picked up more than they have, but some of the permitting and the federal ground on the Permian out in the New Mexico area has had to shift some people. So there is speculation that the whole thing will actually help us because we're right in the heart of the Permian. So does that mean increased activity in the months to come? Due to some of those changes, coming up, it's hard to say, but I think what we're hearing from our customers right now is, steady increases as long as things don't change. So we're again cautiously optimistic that we'll continue to see the trends we've seen in the last couple of months.
Thanks, Jody. And my last one is probably a multi-part question, but it's Impact Van. Really nice quarter. Just here's the parts to it. Curious if you're seeing, obviously GLOs were strong. Is that continuing to accelerate? Meaning, is this something that you think is going to be even stronger in the back half of the fiscal year than in the first half? And are GLOs tied to the COVID-related activity you're seeing? And then on the COVID-related activity you're seeing, is that more sales, more rental? I'm just curious if there is a meaningful difference, because I thought I heard that there were some sales involved there, where I would think it would be more rental type activity. So I'll cut it off there, but thank you very much, guys.
Yeah, so your GLO, the first part of the question is, as we just continue to see that product be more and more accepted, across all industries. So yeah, there's no question we have units going out for testing facilities, now vaccine facilities. There's lots of different applications related to the pandemic. But I will also tell you, normally, through this time we really start to pick up on events, right? So when the economy does start to get back to normal and events happen, that's a big application for the GLOs as well. So across the board, I think again the product is getting more accepted. No question, there's COVID-related activity, and we continue to get new opportunities every day related to the COVID changes, in businesses. And I mentioned on the last call, from maybe pickups from grocery or product. People don't have facilities outside, so I think it's going to change the way businesses do business going forward. So we're hoping that that's very sustainable, and then event business, when it comes back, would offset any decline that we have, including construction, to offset any decline we have from COVID returns. So we are seeing good, steady growth, and we don't look for it to change. To answer your question on the GLO side, we're very optimistic.
Great, thanks. Excellent question. Just a quick follow-up on that. Is the COVID-related activity mostly in GLOs, or would you say equally in your other offerings? And then just I'm curious. I assume it's mostly rental, but is there a high level of sales activity? Thanks.
Yeah, I mean, most of the activity is related to GLO, but I would say, we still have a lot of containers going out for different storage applications and things related to COVID too, but not to the extent that the GLOs. So that definitely is the strongest product, COVID related. And then to answer your sales question that you'd mentioned earlier, it's a unique environment because containers are a little harder to come by. So, we've been able to see margin expansion. I think we'll continue to see some margin expansion. There's certain companies that are doing modifications to the containers for certain application around COVID. So we are seeing some sales through those channels, but just our normal sales channels, we're seeing expanded margins just because there's less units out there for sale, and therefore driving up price. So, the long-term effect of that may be also a boost in leasing, right? As people may not invest as much, it could, boost the leasing business as well. But right now, the sales business has been very steady. We were cautious about it. If you remember a couple calls ago, we said, we don't know what this is going to do with the pandemic, but we've seen no drop-off.
Great, thanks. Appreciate you taking all the questions.
Yeah, thanks, Scott.
Our next question comes from the line of Brent Thielman of D.A. Davidson.
Thanks. Good morning. Congrats on a great quarter.
Thank you,
Thanks,
Brent.
Brent.
Good morning.
Hey, Jody, there's been reports out there about shipping container storages, and I just wanted to get your input, whether that's having any implications to the industry right now.
I think it will. Definitely on the sales side, it's impacting it. I mentioned earlier, we are seeing less units available secondhand right now for sale. But again, we've been able to offset the volume by margin, which is nice. But I think we've seen this a couple times in the past, but not probably to the extent we have now. And new unit prices are really jumping up right now. It's simply supply and demand. So we had units already ordered prior to our lease fleet's in great shape. It's gave us a chance to clean up anything that's older and not as desirable. So there's been some pros in that process as well. But there's no question that the availability is tighter right now than we've seen it in quite some time. But it is driving up margins.
Yep. Okay. Maybe the Asia Pacific leasing revenue on a local currency basis was under, I guess, a little more pressure than we've seen in preceding quarters. Just be great to get your latest views on the business environment there, the opportunities you see right now. Is there any concern, we see some further deceleration here? Just love to get your perspective there.
Yeah, I would characterize it as they were much more, the government I'm referring to was much more aggressive with the shutdowns. So, their business is really across the board. You couldn't hardly get, out of the house for a while unless, there was something, groceries, medical, that type of thing. So, I mean, it was a little more severe and drastic than it was here and caused, probably further delay for a time period, but things are getting back to normal and released there now. The whole Asia Pacific region is reporting good activity and economic growth. So I think we're pretty optimistic about the Australia New Zealand market. Our management team, which is very close to the customers there, are giving a good outlook as well. So we feel like, that the shutdown really, kind of stalled out any kind of growth that we were having just because there wasn't any business going on. New construction sites were not getting released. Now that has changed, and we're hoping to, see the lifts in the quarters going forward.
Okay. And back on PacVan, it seems like one of the uncertainties out there, Jody, is just, what happens or doesn't happen with non-res construction. Any perspectives you can share from, the branch network on what you're seeing around customer inquiries, orders, particularly as we get into the busier kind of spring and summer months for construction? Is there greater hesitation? Is there more confidence? Just be great to get some read-throughs from boots on the ground, I guess, around that particular market sector.
Yeah. So, you guys get the ABIs as well. We watch it very closely. We have systems that feed, the leads from Dodge and construction, projects. We've kind of been waiting to see, if there's going to be a big drop, and so far we haven't seen it. Although through the COVID, we maintain our business level in those sectors very nicely. And so now we're hoping that we see, some projects that have been delayed, kind of restart here in the spring. But, I would tell you that that's one sector that we're watching the closest. But right now everything seems okay. And hopefully, with the stimulus and the delays that have happened over the last year, there's some suppressed starts that will happen. I'm sure there'll be some drops in hotels and restaurants and some of those venues. But we're hopeful that that'll be offset by some other other construction-related projects. But definitely a sector we're watching very closely.
Okay. And then in advance of the 10Q coming out, and I know there'll be more detail there, of all the different asset classes, where are you seeing the most rate momentum? Is it still in GLOs? Where are you seeing the momentum right now on the rate side?
Yeah, we had great rate improvement across the board, but our actual biggest increase came from the mobile modular side. We were actually double-digit rate growth in the mobile modular side, and closer to that 5% where we've been on the containerized. So rates are still doing extremely well, still going up, and mobile modular kind of still leads the way.
Got it. Okay, I'll pass it on. Thank you, guys.
Thanks, Brent.
Once again, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. Again, that is star 1. We do have a follow-up question from Brent Thielman of D.A. Davidson.
I'm back. Thanks for taking my follow-up. Just on the guidance, a clarification on the commentary. Does the increase from what you were expecting previously contemplate a better kind of oil and gas and liquid containment environment, or should we look at this as really an improvement for the rest of the business?
Yeah, I think we're looking at improvements in both areas. Our oil and gas, as I mentioned on the call, we've seen nice trends the last couple months with some increased activity. So, we're hopeful that we'll continue to see some uptick there. But our core business is very strong, and so I would say it's really all the above. Our core business as well as oil and gas, but oil and gas it's less than 9% of our business. So even if it has an uptick, it doesn't have as much impact. But our core business, we feel like, is just going to continue to be strong.
Excellent. Thank you, guys.
Yep.
Once again, if you would like to ask a question, please press star 1. Our next question comes from Luis Hernandez.
Yes, hello, everyone. Good morning.
Good morning.
Good morning, Luis.
All right. I got a question on the guidance. You're guiding for around $90 million for the fiscal year 21. Around 90.
Correct.
And your current quarterly was 20, almost 27, and the 6 months is like 48. So are you expecting the next 2 quarters to be like lower, much lower?
Don't expect to be much lower, no. But we are expecting it to be a little lower, yeah.
Yeah, Luis, our biggest quarter is second quarter fiscal, with retail season. Typically the winter months, which is the quarter we're in now, we typically have, some drop off and then, build back up in the spring.
And
right.
Luis, the big reason for why it would be lower is primarily with Lone Star Oil and Gas. I mean, Q3 of last year, Lone Star had adjusted EBITDA of $2.3 million. We're not forecasting anything near that. So.
Right. Okay. Then the other thing, do you expect for the full year, do you expect working capital to produce cash or consume cash?
Well, Luis, working capital is always, goes back and forth. But, I would say generally I would expect it to produce cash.
Right. Okay. All right. All right. I guess that's it for me. Thanks.
Thanks,
Sure.
Luis.
Thanks, Luis.
That was our final question. I will now return the call to Jody Miller for any closing comments.
Thank you, operator. I would like to thank you for joining our call today. We appreciate your continued interest in General Finance Corporation and hope everybody remains healthy and safe. Have a great day, and we look forward to speaking to you again next quarter. Thank you.
Thank you for participating in the General Finance Corporation's earnings conference call. You may now disconnect.